Welcome to the Markets and Leaders podcast. I'm your host, Lyndsay Malchuk, and today we're cheating a little bit. Normally, I sit down with one incredible guest at a time. But what happens when you take some of the smartest moments from politicians, from economists, investors, CEOs, and industry leaders, and you put them all into one episode? You start connecting dots that you didn't even realize were connected. From Hollywood taking on Wall Street and AI to why your investment portfolio may need a complete rethink, to the race for critical minerals, climate risk, government policy, and where billions of dollars are flowing next. These aren't just great interviews. These are conversations everyone should be paying attention to. And that's exactly what today's episode is all about. We've gone back through some of our favorite conversations and pulled out the moments that made us stop, made us think, and sometimes completely rethink what we thought we knew. So whether it's markets or politics, mining, Hollywood, technology, or the economy, these conversations all have one thing in common. So let's start with the topic that has sparked plenty of headlines, opinions, and debate. You've probably heard the acronym DRIPA, but what is it exactly? And more importantly, what happened to make it such a controversial topic now? Former BC Cabinet Minister turned president of AME, Todd Stone, was there from the beginning and played a key role in its creation. Here's what he had to say. Okay, so today, actually, we're not going to talk about your trip. We are actually talking about something that is very controversial in our province, our industry right now. We're going to talk about DRIPA.
Yes.
So we're going to start right from the beginning. What was DRIPA actually created to do?
Well, so before we get fully into DRIPA, I would just want to say this.
Step back.
Just step back. Everyone in the mineral exploration industry, the broader mining sector, there's always the odd exception, but generally speaking, people that have been engaged in looking for the minerals for the mines of the future, and people that are involved in building the mines and processing and whatnot, there have been good relationships with First Nations, for decades, generations, frankly.
Yeah.
Now, has the nature of the relationship and the engagement and the consultation and the participation and whatnot evolved and changed? Is it different today than it was, 30, 40 years ago? Yeah, of course it is. Mm-hmm. But I think it's just really, really important to just say that at the front end, that certainly our members, and I know most companies in exploration and in mining, understand that it's actually a significant opportunity. It's a significant leverage, a positive leverage point to actually have a great relationship with your local First Nation, have them involved early and often in the project. And in today's day and age, it's more about, full participation as equity partners, as, co-managing the projects, those types of things. So I just want to start there. But DRIPA, when it was brought in.
Hold up. One more thing though.
Sure.
One more thing. You were part of this DRIPA organization at the beginning, were you not?
Well,
you have a background in office.
Yeah. So I was a member of the legislature here in British Columbia for almost 12 years, and including in 2019 when the DRIPA legislation was brought forward and debated for weeks and weeks and weeks in the legislature, and so I do have that unique perspective of being someone that was there, in the debate, while the debate was taking place in the middle of it. I was there, to hear firsthand the undertakings of Premier John Horgan. Bless his soul. He was a good man. I was there to take in the testaments from the First Nations leaders that participated, and I was one of the MLAs that unanimously across all party lines voted in favor of the DRIPA legislation at the end of the day. So I think that offers a unique perspective in terms of kind of what it was positioned as at the time and what it has become today, and why there are some challenges and some concerns about kind of how it's evolved.
Okay.
At the time when it was brought forward, it was very much billed as a significant opportunity to recast reconciliation, but in an aspirational way, not as a this legislation in and of itself would trump the laws and the regulations of the province of British Columbia.
Right.
It was very clearly stated by government that in the answering of questions that was posed to government by the opposition. I was in the opposition. That this legislation was not intended to provide consent. It was not intended to be a veto, to provide a de facto veto over projects. It was not intended to require consent-based decision making being driven deep into the regulatory processes of, let's say, mineral exploration, for example. But rather, it was aspirational. It was a set of values that would guide industry, government, and First Nations as we walk hand in hand, arm in arm together down the path of reconciliation.
Policy shapes the rules we all live by. We know this. But here's the funny thing. Attention has rules too, and they're changing just as fast. Not that long ago, Hollywood's biggest competition was, well, Hollywood. Today, it's TikTok, YouTube, Netflix, Instagram, podcasts, video games, even the person sitting beside you scrolling on their phone. The battle isn't for more movie tickets anymore, it's for your time. Brian Balthazar has spent years inside the entertainment industry as a producer, as executive, and entertainment reporter. And his take on why Hollywood underestimated the creator economy is fascinating. Brian, tell us more. Well, one of the things that's fascinated me is that Hollywood isn't just competing with Hollywood anymore. I mean, you said it right there. A movie isn't competing with another movie. It's competing with other platforms altogether. TikTok, YouTube, podcasts, sports, Instagram even, like video games, group chats, and honestly, just life. It's just competing with life. Did the industry see that shift coming, or did everyone wake up one day and just realize we're competing against each other far more than we realize, or we're not competing against each other, we're competing against other platforms?
I do think it was like seeing a ship far off in the distance. It's coming, and it looks like it's coming slowly. But then suddenly, like, oh wait, it's getting bigger. I see it now. I can see the wake. I think the way in which video games have become more and more realistic looking and looking more like films themselves, was a cue. Now, whether or not everyone saw it or heard those signs, or saw those signs, or heard those cues, it's hard to know. But I do think a company like Microsoft, Xbox, that is very much the way in which they behaved over recent years in buying more than 30 game studios to create some of their games. That's not unlike the network model. Like, they've been trying to acquire the most content, to be the place that everyone goes because they know they'll find it there. So there has been a trend of that. They're very much mirror images of each other in the which they've tried to acquire, make more content, acquire companies, win market share. All of those things are kind of common among companies like Roku, Netflix, Xbox. They're all doing the same kind of thing. And now, as we face all these mergers, it will remain to be seen how they take what they have now, how they economize on it. Is it going to be a story of cutbacks in economy, or will it be a content growth? It'll be interesting to see what they do next. That's going to be what everyone's watching, anyone who's invested in any of these companies.
I may be aging myself a little bit, but growing up, I mean, if you wanted to make it, you dreamed of it in Hollywood. Today, millions of kids, they dream about becoming YouTubers. Like, my son is like, honey, what do you want to be when you grow up? And he's like, I want to be a YouTuber. That's never going to happen.
It's true.
So and
it's funny because YouTube is the largest platform because it just
really
keeps generating user-generating content. Its library is constantly, as we speak right now, think how many thousands of people are uploading content. So it is
100%.
It is by leaps and bounds the largest, network, if you will, and now that we have, movies running on there, we have comedy specials on there, we have user-generated content. I remember as a network executive, there have been times that we would reach out to someone who had a huge social media following to see if they wanted to discuss having a television show. Some of them didn't want it because it's too much work for them and not 100%. Enough return, not enough money, because they make more money posting on YouTube or posting on TikTok than
some of the biggest names in entertainment.
Because when you get a first season of a television show on a cable network, You're not making that much money, particularly an unscripted show. I'm not talking about a scripted show necessarily,
Right.
But they're making a lot of money doing this. The question is it sustainable for many of them? A lot. We're still at a stage where we haven't seen many of the young TikTok stars. I said TikTok. We're still at a stage where we have not seen a lot of internet stars in their decades later. Like, what is it going to look like for that hot 20-year-old TikTok star? What's it going to look like when they're 50, 60, 70? Do they not need the money anymore? Will audiences still care? Will they still want to do it? So it's still very young, the life of an internet celebrity. We're still going to see how that shakes down in a lot of ways.
Do you think that Hollywood underestimated the curator economy, or did it simply happen faster than anyone just imagined?
I think both. Right. I think it's interesting because every once in a while you'll hear about a TikToker or a Instagram star, social media star getting a role on a film. Noah Beck, I believe it is, who's going to be on the Baywatch reboot.
No.
You hear them once in a while, but you don't. What did you say?
There's a Baywatch reboot coming?
Oh, yes, of course. Because the one thing that never changes is sex sells, right? You put a bunch of people that are, good-looking people on the beach in swimsuits, people are going to watch. The problem is now you don't have to look far to get someone in a swimsuit. They're on Instagram already.
They all want to be it. Who's the next Pamela Anderson character then? I mean, she just turned 60 or 59 or yesterday, I think it was her birthday.
Yeah, recently, yeah.
I wonder who that's going to be. I actually sat with her on an airplane back from Germany not that long ago, and the most lovely human being in the world.
I love hearing that. I believe it too. It's coming through. I feel like we're finally seeing the most authentic version of who she is.
100%. She's so gentle, and we ended up kind of looking out for each other. So if one of us fell asleep, we'd tell the crew there what the other one wanted. She was so sweet. She was so sweet.
That's so nice. I love that.
It's nice to hear the things. Okay, so content creators have disrupted Hollywood. Now climate is disrupting business. Maybe not the comparison you were expecting, but think about it. Both are forcing industries to rethink the way they've always operated. For years, climate conversations centered around insurance claims and disaster recovery. Today, companies are asking much bigger questions. How do we keep employees safe? How do we keep our investors safe? How do we protect operations? And what risks can simply be covered with a policy? Raul Munoz from Marsh explains why climate resilience has become far more than an insurance conversation.
Some of those risks, they are 100% manageable on paper.
Yep.
They show up as models, as forecasts. They show up as insurance frameworks, risk transfer mechanisms, all the things. But, Raul, we know that reality is we don't care about models. It doesn't fix anything. It doesn't prepare for anything. Which climate exposure are already insurable in theory, but operationally unmanageable in reality?
Let me think about that for a second. If you're talking about climate change, I would say all of them.
Okay.
There's always an insurable component to anything,
Okay.
right? But insurance only plays this very, very small aspect of what you do, and you can model. That's the basis of an insurance company, right? An insurance company will model a risk, they'll price it, they'll underwrite it, you buy that, and there you go, right? But we know that that's the tip of the iceberg.
We know.
Yeah. And so we need to think about some of the things that can go wrong, right? Look at wildfires, for example. Last year, was probably one of the most active wildfire seasons in North America, starting with the forest fires in California.
Yeah.
Following with a lot of forest fires in Manitoba, in British Columbia, in Quebec. And so I think that when we look at how that's affecting how companies think about climate risk and where they operate, is something that needs to shift. If you're going back to the conversation on insurance, right? There's only a portion that is insurable. Companies still need to absorb vast amounts of capital on retentions. they also need to think about, what about workforce, right? If you as an operator are suffering a loss or an unplanned shutdown because of something that's happening in the environment, you can guarantee the people that are working for your company are also experiencing the same. 100%. And what is their priority going to be? Their families, their friends, their livelihood. Perfectly understood and perfectly acceptable. So it's all of those, that trickle down effect that happens when you consider risk, that go far beyond whatever is insurable. That I think, to your point on whether you model it or you don't, it's really somewhat unmanageable in many cases. Yeah.
Do you see from your perspective that more people are noticing, the spread of the wildfires, the more common they're becoming? Do you see from your perspective that they're factoring that in more to their insurance now?
Absolutely.
Really?
They're not only thinking about, insurance is really the last line of defense in this whole aspect, right? The most important component is, how do you state resilience? What are the things that you can do to not have that issue to begin with? You cannot prevent a forest fire from happening. That is just reality. But you can prevent or mitigate how that's going to affect your operations, how that's going to affect your personnel, and how it's ultimately going to affect your bottom line as a company.
Fair enough. So at what point do you think this stops being about environmental and starts being about financial survival? It stops being a sustainability conversation and really starts shifting to a capital conversation.
It's all about adaptation, right?
Okay.
So we were talking about, 5-10 years ago, we were talking about climate change as an issue, as a risk. Now we're talking about climate adaptation. And so when we use the word resilience in any context, it's really, how do we adapt to all these things that we cannot control? And we're seeing that across the board. The question on resilience, on how do we adapt to climate change, is a question that dominates boards. I sit and I talk to C-suite and boards all the time, and it's a question that comes on over and over again. It's like, what are we doing? What are we going to do in the next 20, 30, 40 years to be able to withstand, to be able to manage some of those issues?
It's amazing how often we hear the same phrase these days. The old playbook just doesn't work anymore. And that applies to climate. It applies to business. And according to Ronald Stoeferle, co-author in the In Gold We Trust report and managing partner and fund manager at Incrementum, it also applies to investing. Now, for decades, investors leaned on the famous 60-40 portfolio as the gold standard. Then inflation showed up and rewrote the rules. Here's why Ronald believes investors need a new framework.
It's been a really good start for gold and silver. Crazy couple of weeks. No, it's been good, and we're already working on the next report. Will be the 20th anniversary of In Gold We Trust, actually.
20th.
Yeah.
I say for the 20th anniversary, the cover has to be pure gold. I'm just saying, just saying, right? Yeah. And then it becomes like not just a read, but an investment too.
It's a good idea.
I think I'm onto something, just saying that.
You're going to sponsor it?
Yes, 100%. I'm in, 100%. Okay. I want to dive in here because there is a lot of things that I do want to cover, okay? Now, you opened this year's thesis with a statement that was, we're going to say, a bit controversial, okay? The old playbook broke. Before we even talk about gold or commodities, I just want to hold a moment for this space right now. When you say the old playbook broke, Ronnie, what broke?
Well, the view in the Western world that inflation is not a concern for portfolio construction.
Right.
And that's basically the reason why the 60-40 portfolio doesn't work anymore. So 60% equities, 40% bonds.
Yep.
And the assumption has always been that, if equities face a hard time, they're struggling, then actually bonds are basically the insurance policy of your portfolio. That used to work for almost 4 decades. But since 2022, it doesn't work anymore. And this is why we came out with the so-called New Gold Playbook, where we said you have to have a slightly different standard allocation for your portfolio. Right. So the old 60-40 doesn't work anymore. So therefore, we created the new 60-40 portfolio. And actually, it really works out. It it performs tremendously well compared to the old version in real time.
Well, we're going to definitely unpack that a little bit more, a little bit down the road. I want to stay here for a second. For decades, investors really relied on a simple assumption. And that assumption is when stocks fall, bonds rise. Now, as you mentioned, 2022, that entire thing shifted. And now we see stocks and bonds, they're moving together simultaneously. That correlation completely flipped the script, 100%. Stocks and bonds, that whole thing now, it's changed the absolute foundation of portfolio construction. So what changed here structurally?
Well, it was inflation, obviously. Inflation in 2022 came back, and obviously, a couple of reasons for that. There was the Ukraine war, but then, of course, also, the lagging effect of all those COVID stimulus measures. Where, whatever it takes, not only rates were lowered, but also, there was an enormous amount of fiscal stimulus.
Yes.
And we said already in 2020, well, inflation is around the corner. Nobody really believed us. And it was like a little bit in this story, The Boy Who Cried Wolf, where, after the third time, nobody believed the boy who said, well, actually, there's a wolf attack. So inflation happened, and I think since then, I would say that this inflation psychology has completely flipped. Right. So we're getting used to ridiculous prices for whatever, for food, for traveling, for
everything,
for real estate, for you name it, and I think that's. This kind of inflation psychology is something that we're pretty used in emerging markets, but we haven't seen that in the Western world. So we had this great moderation where inflation rates came down since the 1980s, interest rates came down, bond yields came down, so bond prices went up. And that was the reason why this 60-40 portfolio worked so well, because people couldn't care less about inflation. Right. Now, I can tell you, Lyndsay, I've been doing keynotes in 35, 40 different countries. Yeah. And the best questions about gold are asked in countries like Turkey, for example. So I did a keynote there in Istanbul a couple of years ago, and I was really, they asked the smartest questions ever.
What?
They knew everything about gold. Why? Because for them, if you construct a portfolio in a high inflation country like Turkey, inflation is like having a proper view on inflation, if it's going to go higher or lower. That's the first question that you ask yourself. So for them, it's just natural to hold gold, to hold hard assets. While we in the Western world, we're not used to that.
No.
We're not used to higher inflation. We're not used to inflation volatility. And I think this is now really changing. And that's also one of the main reasons why I'm still pretty bullish on gold, because I think from this, if there's a big pie of investment allocations, by far the largest pie is fixed income. That's 160 trillion. Right. And if there's from this big pie, even small pieces move to the gold, to the silver, to the commodity space, that's going to have a big impact on those on a relative basis, pretty small pies.
Yeah. Well, I mean, you touched a little bit on the 60-40 split. So historically, that classic 60-40 portfolio has experienced lost decades since, the 1900s, right? Are we entering another one right now, you think?
Yeah. I mean, it actually started in 2022.
Okay.
So now it's 26, say still pretty early. And based on this graph, it usually, it's on average, it's a decade. Okay. Where this 60-40 portfolio doesn't work anymore. So one of our main assumptions is that we're in a structural bear market for bonds. Right. And I think that you've got some, closet gold bugs in institutional asset management. So a couple of really big guys that I'm talking to, they actually know that you will have guaranteed losses, especially on an inflation-adjusted basis with those fixed income allocations. But they've got their mandates. So I would say that it won't be like in the 1970s where we've had bond funds actually holding up to 40% physical gold. It's not going to play out like that because of financial repression. But just one number that came out by Bank of America yesterday. So they are forecasting for the US to have, on average, yearly deficits of 2.4 trillion every year in the next 10 years.
Whoa.
And that's under pretty, I would say, optimistic assumption. And the assumption is that the US won't face any recession over the next 10 years. So if there's a recession, it's going to be even higher.
Right. Well, we've heard quite a lot right now. And what we have heard also is markets are always chasing the next opportunity. But here's the catch. The biggest opportunities often start long before Wall Street talks about them. Governments know it, major mining companies know it, and increasingly, they're choosing to buy quality discoveries instead of spending years trying to find their own. Adrian O'Brian, VP Business Development and Communications for Midnight Sun, explains why capital is flowing differently and what that means for the future of resource investing. I think it goes far beyond just what's in the ground, too. It's really how to get it out of the ground and who can get it out. So I think each country really is becoming more diligent on how fast, how efficient, how safe, how sustainable, all the things. That's really coming into the limelight a lot more. I mean, here in Canada, we have our own, things going across each province. But Ontario, I mean, they quietly just passed, I think it was June 15th, Bill 5. And that really brings in expedition processes for permitting and for all the regulatory. And they have, a special critical mineral sector now where the government can actually choose which critical mineral regions within that province are more beneficial. And so, critics will say, well, that gives the government too much of an upper hand. And how are they deciphering between what is actually good and what isn't as important? So there's a lot of balance, but each country is going, we need to make some moves here.
For sure. And then think about the different funds that are out there. Another thing that we see on the investment side in terms of looking for funding for projects is that governments are setting up funds or backing funds specific to deploying government capital for each country into projects directly. So you don't just have groups like the Department of War out there looking at funding projects, and it's a massive amount of capital that the US has set aside for investments in projects directly through the whole stage of the continuum.
My gosh.
But you actually have funds whose mandate it is to deploy capital into critical minerals projects. And we see that in France. We see that in a number of places. And that was another topic that I saw at a recent conference where they had representatives there talking about, how they're assessing projects. How do they figure out which ones are worth putting money into? Are they early stage? Are they, and that's the toughest thing is as an exploration company or as an earlier stage project, it's tougher to get access to that capital. Right. But you do see that they're, some of them are setting certain parameters. So let's say you need to reach bankable feasibility first, or you need to reach, whatever that measure may be. But they are looking to deploy capital and serious capital.
Well, do you think that those great discoveries, they're behind us now? And that's why there's a lot of companies like, the majors that are looking now more so at the juniors going, we don't have the time or we don't have all of the land or whatever anymore because those great ones are gone that we can have access to. So do you think that those majors are now looking at the miners going, we want to buy in or we want to take over, or we want to do all those things because you guys already have the resources, the time, you've already done all the work. Do you think this is one of the reasons why?
I do. And I think that's a really interesting point because what you're seeing now is you're seeing I'll put it to you this way. When was the last time you saw an announcement that a major mining company made a grassroots discovery? No. They don't do it because they don't have an exploration division like they once did. And I remember my earliest years in this business, I remember majors making big discoveries. I remember stories about it. And certainly you do see it from time to time. And our Kevin that's involved with our project, Kevin Bonnell, of course, he made 2 major discoveries working for Barrick, but that was associated with a known deposit. when was the last time a major went out and made a completely grassroots discovery in a completely wide open, different jurisdiction they'd never been in?
You don't
Doesn't
hear
happen very often. No. So, I think that they're definitely looking to the junior side. They're looking to help the junior side. Governments are looking to help the junior side in that early stage of discovery. But what I always like to say, and my favorite line for this, is that all the low-hanging fruit has been picked.
It is. You have to go deeper. You have to go wider.
Exactly.
You have to go outside the think of the box. Do you think that then changes how mining companies think about building their projects?
I don't know if it affects how they think about building their projects. I mean, I'm sure to some degree it does. I think it governs what jurisdictions they want to go into.
Okay.
I think it governs how they get into those jurisdictions. So if you think about the idea that, look at another area I'm kind of close to is Egypt. Look at Egypt as an example, okay? There's a place where there is absolutely no real history of exploration because it was always too difficult to go in there. And of course, a few companies went in. Centamin did. Centamin went in, discovered Succurro. So they make this massive discovery, becomes a 16 million ounce deposit. Endeavour makes a $2.5 billion offer in 2021. And then finally, AngloGold Ashanti buys their stake in it for $2.5 billion last year. And that was only 50% ownership.
Wow.
So you look at a place like that. Now, there's an untapped jurisdiction. Are there majors crawling all over it looking to make discoveries? No. There's AngloGold Ashanti. Who else is there? One or two juniors. Okay. So you think about jurisdictions like that, you think of the far north, you think about areas where people historically haven't gone.
Right.
And that's kind of the new frontier, right? So you have to look at where are the best jurisdictions, where are the opportunities to get into. But it's always juniors that are out there blazing the trail.
So do you think success then looks more like going forward? Do you think success looks more like partnerships in jurisdictions or?
It could.
Yeah.
Depends on your outlook. Like I'm not a big fan of earn-ins. I'm not really very quiet about this. I say this all the time. I'm not a fan of earn-ins to projects simply because you're giving away too much upside too early.
Right. Yeah.
All depends on your model.
Okay.
Depends what you want to do. But as an explorer and as somebody out there doing this stuff, to me, the onus is on the juniors. This is our job. This is our end of the continuum. We're really great at making discoveries. That's what we've done for a long, long time. That's what most people in our business are great at. So we need to be out there. We need to be aggressive. We need to raise large amounts of capital. We need to deploy that capital in a way that we get our projects to fruition quickly. And I think the industry can look at it and take a little bit of the onus on ourselves. Like, how many companies are out there that run very small drill programs, pick away at projects for 4, 5, 6, 8 years, maybe longer? What does that do for us? Does that get the market excited? Generally, no. Does it develop, real value for shareholders? In a lot of cases, it doesn't. How can we turn the whole model on its head? How can we change it to make it more effective and to get projects to fruition more quickly? Wow. And our answer to that with Midnight Sun was to raise a lot more money than typically had been done in the past. Raise a lot more money, come up with a focused effort and a plan that allowed us to take our project from 0 to, call it, better than 50% in less than a year.
Okay.
And I think other companies do that as well. I've seen it. Our plan has been extremely aggressive, particularly aggressive in terms of the pace at which we've been keeping, the amount of drilling we've been doing, what we've been doing. But I just think it's just one example. But we have to think about that. Like, how do we get these projects move forward more quickly? How do we make more discoveries? How do we deliver more shareholder value by doing things quickly and effectively, not wasting money and not wasting time? And time's the most valuable thing. And right now, with the race to critical minerals getting to market, we need those things advanced as quickly as humanly possible.
Absolutely. If you've noticed one theme throughout today's episode, it's this. Change doesn't ask for permission. It shows up. Regulations evolve, technology evolves, markets evolve. And investors have to evolve right along with them. Attila Kadikoy, managing partner at Levantine & Co., has a front row seat to those changes. From the rise of AI and data centers to the increasing regulations reshaping asset management, here's Attila.
But let's start with the bigger picture first, okay? The world of asset management is changing, and it's changing fast. From your point of view, what has shifted the most over the past few years?
I'd say one is regulation.
How so?
So the regulatory bodies, especially after I say 2008,
Okay.
big crisis, slowly regulation increase. And then what that caused is M&A activity and consolidation into larger companies.
Right.
And also the growth of small and medium specialized companies like ourselves,
Right.
where the business model and the way we generate income is different. Basically, you came from a sector that was very driven by upfront fees, not very transparent, and regulation changed that. Also, definitely, I would say that there's a shift in how portfolios are constructed, and also the changing tax environment has really had a major impact
Right.
on asset and wealth management.
Right. That makes sense. Across the board, what we're hearing is watch out this year for a lot more M&As coming. So
True.
we're going to see how that goes. Investors are seeing so many headlines in new technologies, and we're going to talk about AI here. How are they actually reacting to these changes? Do you think that they are embracing the opportunities, or do you think that there is a lot of hesitation right now, or still?
From an investment perspective, absolutely. If you look at the drivers of the S&P in 2025, it was very much led by the AI boom, let's call it.
Okay.
And deliberately not using the word bubble.
Oh, absolutely not.
And AI is here to stay. AI is extremely important technology. But while embracing it, you can't, this is the big thing, you can't embrace it with a blind eye.
Okay.
Because there's going to be winners, there's going to be losers.
I was gonna
High
ask.
adoption, you see a high adoption, but which companies are going to make money? And when you look at how the market reacts, for example, DeepSeek.
Okay.
Do you remember last year, DeepSeek
Yes.
came out of China and the chip companies sold off? All those actions are, I believe, not misled, but based on limited information at
Fair
the
enough.
moment. Because we don't know where the companies are going to be which companies are making revenues, how much revenue they're going to make.
Right.
The hardware is, for now, quite secure in the short run still. Interesting fact that people aren't watching is due to all the data centers, etc., the energy sector is something to watch.
So true. This is what we're hearing too. Yeah.
So China has, let's say, got sufficient energy, but do other countries have sufficient backup energy? Because as you might know, bringing energy online takes years and years.
Yes.
So there are other parts to the AI technology story that people might not be
So true.
seeing.
Artificial intelligence gets the headlines. Interest rates quietly move the world. They're not flashy, they're not on trending social media outlets, but they are influencing everything from mortgage payments and real estate to stock valuations and the cost of borrowing. Michael Succurro, managing partner and CEO of Spark Financial, has a great way of breaking down complicated financial concepts without making your eyes glaze over. Here's his take on bond yields and why they matter more than most people really realize.
I want to reset this conversation in the simplest way possible, just for a brief second, because the second people hear bond yields, they're gone. So let's pretend I'm not in the media, I'm not markets, I'm just someone sitting across from you asking a very basic question. Michael, what is a bond?
Yeah, no, it's a great question. Yeah, I get asked that all the time because again, I'm explaining to clients how the rates work and what they're reflecting of as to how we come up with the pricing. Not myself, but how the lenders come up with the pricing on how to offer these rates. So a bond is just another investment vehicle that large banks, large investors, even everyday people can invest in that fluctuate on the market, just like any other stock, any other equity, any other mutual fund you would see out there. But this bond yield is what's backing our fixed rate mortgages.
Okay, so when people hear yield, what does that actually mean? Is that just the return you get from lending your money?
Yeah, well, the yield is just like in any other investment. It's what you're going to be yielding off of that deal. So the 5-year bond yield is going to yield you X amount of dollars.
Yield
So
would
right
mean
now,
your return.
speaking, it's live. Yield or return, yes.
Okay. So if we strip all the language away, a bond is basically you lending money, and a yield is what you get paid to do just that. Yeah?
Exactly. To put it in simplest terms as a product that everybody knows is when you're giving the bank money to invest in a GIC, a guaranteed investment certificate, the bank is taking your money to go lend it out or use it for leverage. So they're going to say, hey, we're going to pay you a 2% yield for the next 4 years because they know they're going to hold your money for the next 4 years, and they're going to lend you, they're going to lend that money out and make money on your money. That's how the banks work, and that's how they make their money. So that's the same thing with the bond yield. That's why the bond yield affects the fixed mortgage rates, because that's what the banks are using to lend that money out. That's what they dictate. Okay, we need to make X amount of spread. So it's just like the Bank of Canada prime rate.
Yeah, so that's a really great example. Let's actually make this even more real. If I can lend my money and get paid more to do it, that sounds great. But the problem is, when that number goes up, it changes everything else, doesn't it? So help me connect this. If I can earn more just by lending money, why does that create pressure across the entire market then?
Well, it creates pressure because now it creates a rising cost of borrowing money. So if you're that end user that ends up receiving the money that's being lent out, you're getting it for top dollar. So to give you a simplified version of it, the Bank of Canada always releases a Bank of Canada prime rate. And it's always, right now it's at 2.25%. So they're like, okay, well, we're not going to lend the money out at 2.25. That's what we're getting it at. That's what we're going to offer it to you. So the banks are getting that money at 2.25. They want to make their spread. And that's where you're getting the variable rates. That's why the rates are at 4.09 right now to 4.25. Before this call is at 4.36. I looked at it. They're fluctuating every day. But that's the bank making the spread on the money that they're borrowing.
Okay, got it.
They're carrying on that cost to the end user. And that's how the banks make their money. So it's the same thing. Anybody could become that investor. They could become the bank. That's a whole other topic where it's called private lending. But you're passing on that cost to the end user.
Okay. Why does that make things like real estate stocks, even businesses, feel tighter? Because I think this is where people are confused. They're sitting there thinking, why does everything feel more expensive? Why does it feel harder to move forward financially? Why does it feel like money just isn't going as far? Is that directly connected to this one shift?
It's primarily directed to this one shift because, again, this shift affects the entire economy in the sense that, again, when we're looking at the Bank of Canada rate updates, they're looking at two main factors: what's unemployment at and what's inflation at. And as of right now, they're saying on the next announcement, they're most likely going to actually increase the rates because inflation keeps climbing. But what might hold it back is that unemployment is also climbing. So they're trying to find the happy medium. So why it affects the entire market is, again, you look at gas prices. So the cost of gas goes up, which now puts strain on the market, less buying power for people. But if they're going to buy anything, they want to charge them a higher rate to purchase that because, again, everything is at an all-time high. That's why you see the groceries are going up because gas is increasing, which is being passed on to the client, which is being passed on to the consumer who's buying these foods, because now it's going to cost you X amount of dollars for your food to get from point A to point B. They're using way more gas, which is costing them way more money.
It's crazy. It's crazy. You know, I saw this meme thing, and it was like, if you want to smell expensive, just head to the gas station and do a little dabble on your wrists and behind your ears, and there you go. Now you smell expensive. That's where we're at right now.
So every few years, markets find a new buzzword. Remember cannabis? What about NFTs? Do you remember those? Now everyone's talking about critical minerals and defense metals. But as legendary investor Rick Rule points out, by the time something becomes the hottest topic in the market, the smartest investors have usually been paying attention to it already for years. Here's Rick Rule on where the real opportunity may still be hiding.
So I'm going to flip over right now to an investor point of view. Do you see that so many companies are starting to pivot their focus over to defense? And then, it's giving them sort of a market's edge to go, well, investors are all following where the money is all going right now. So it's all defense. So do you think they're all just trying to bottleneck into that defense sector?
Yeah, of course. You have a whole bunch of management teams that a year ago couldn't spell defense and couldn't spell the elements that they're now experts in.
Yeah.
This is maybe the 100th fad I've seen in my investment career. I ignore that.
Okay.
If you're an investor or speculator, you find a team that has success and experience in the task at hand. If they're looking for copper in accreted terrain, 25 million year old volcanic rock in Spanish speaking countries, have they done that before? Or was their success in gold in Archean terrain, which is to say unrelated success?
Well,
This whole sort of fad into defense metals likely has legs, but it only has legs for people who know what they're doing. And a very, very small proportion of the people who are suddenly involved in the so-called critical materials could spell those materials 5 years ago.
So what do you think the next trend would be? We're going to go, it was, I don't know, clean energy, and then it was tech, and then it was AI, and then it was now defense. I mean, there's always going to be some sort of trend going forward, and everybody's going to try and hit the next big thing from one word.
Sadly, Lyndsay, you're talking to a guy who doesn't know how to turn his TV on.
I don't either.
The idea that I would be the correct judge of popular culture is probably problematic. I think that one trend, which is very durable, not a fad, is demographics. There are more people on Earth every day, and there are about 2 billion very poor people who are becoming fairly rapidly less poor. Those people want to live like you and I, and that requires energy, and getting the energy to them requires copper. We have underinvested in copper for 30 years, so I'm not trying to say that copper is going to be hot next year or hot the year after.
Right.
But I'm saying that demand for copper will exceed our ability to produce copper 3, 4, 5 years. That's not a fad. It's just arithmetic. It's simple arithmetic. Oil and gas, simple arithmetic. The outlook for oil and gas, the popular perception around oil and gas has been set by, what was that noted energy physicist's name? Greta Thunberg.
Yes.
And, that perception happens to be wrong. So from an investor's point of view, worrying not so much about what the latest fad is, but worrying more about getting on the right side of arithmetic is what I think is important.
Okay.
It's amazing how these conversations, recorded at different times with experts completely from different industries, all point towards the same conclusion. The world is changing faster than ever. Politics are reshaping business, technology is redefining competition, capital is moving differently, and the assumptions investors relied on for decades continue to evolve. The real advantage isn't simply reacting to change, it's understanding the forces driving it before anyone else does. And that's exactly why we keep having these conversations. Every episode is an opportunity to sit down with the people reshaping the industries, challenging that conventional thinking, and helping us make sense of a world that's changing in real time. Be sure to subscribe so you never miss an episode. We've got many more conversations with global leaders, with CEOs, policymakers, and market experts coming your way. And trust me, you won't want to miss the next one. Remember, these are the opinions of our own with possible vested interest in any or all of the companies we may have spoken about. This is not to be used as financial advice. Always be sure to speak with your licensed financial advisor and know your own risk tolerances. For a copy of our complete disclaimer, head over to apaton.com. I'm Lyndsay Malchuk. Thanks for watching this highlight episode, and we'll see you next time right here on Markets and Leaders.